All right. So I am trying out the Ecamm Live today. Looks like my microphone is good. And if you can hear this, let me know if you can hear me okay. Just write that in the comments there. Today I'm going to talk about some risky investments that may show up in your 401k. You may not even know about it. And there's some momentum from the federal government to actually make these risky investments more prominent part of your retirement accounts. So again, I don't have anybody letting me know if they can hear me or not. So if you can, let me know. But I'm just going to keep talking as if you can. Okay. So I want to show you something. I wrote this article for US News and World Report. Oh, good. Okay. Thank you so much, Jamie Temple Art. Appreciate you. I wrote this article for US News and World Report a few months ago about putting alternative assets into your IRA. So I'm just going to use that as an example because it's another related form of retirement account. And you see right here, these assets you can use, they can include commodities, real estate. I'll show you something about that in just a second, crypto. Now, I want to just show you a little bit. Let's kind of dive into what some of these existing alternatives are that you may be already very familiar with that you can put into your account. This right here is the Schwab US REIT Real Estate Investment Trust. And what this is, you've got a yield over here of about 3%, and that's pretty good, pretty conservative. You're really, when you're looking at an alternative investment, chasing yield is never a good idea because you don't want to put your retirement account at this kind of risk. There's a saying, yield is for farmers. And that's what a lot of financial advisors, financial planners, asset managers use to talk about the fact that you're putting yourself in danger for something that really is not typically that relevant for your account. High yields can be unsustainable. And REITs, real estate investment trusts, they're highly interest rate sensitive. So again, you want to be careful. There's a couple REITs, not this particular one. This one specializes in just a broad basket of real estate investment trusts packaged together as an ETF. But there are some, for example, that specialize in some of the cannabis industry facilities. Those are a lot riskier just because of the inherent risk that is in that particular industry because the revenues there didn't pan out as quickly or the way that a lot of analysts thought they might a few years back. So this one, again, yield 3%. Again, you're not holding this to chase yield, just to smooth your return relative to the stock market and help you generate some income. So it is pretty conservative. So let me go back to the US News article. The one I want to talk about today that is not a pretty conservative investment. So I'm just going to sort of compare and contrast the REIT that I just showed you with private equity, private credit. Alternative assets like private markets are now coming into your 401k. These instruments, they represent debt and equity financing not available on the public markets and not available to the average investor. I mean, historically, these have been sort of the purview of university endowments, pension funds, let's see, high net worth investors with at least $5 million, usually much, much more. Hedge funds. Now, these are being brought to your 401k. And I'll tell you a little bit more about what's going on there. However, it could mean higher risk, higher fees for you. So let me show you actually what gave me the idea to do this. And hat tip here to a financial advisor in Oregon. Her name is Courtney Ranstrom. And check out her website. Her firm is Trailhead Financial Planning, I think. But if you look that up, Trailhead in Oregon, she's got some really cool graphics on her website. Really cool. But I found this on LinkedIn, and I connected with her, actually, told her that I really appreciated this. Let me read what she wrote. The story here that she was commenting on is Trump executive order to help open up 401ks to private markets. So, in other words, to allow these plans that you are part of through your employer, that you're saving up your retirement money, to go beyond stocks, bonds, maybe alternatives like REITs, possibly commodities. I'll talk about that in just a second. But into these more risky, arcane, lack of transparency markets. So here's what she wrote. Private equity has outperformed public markets, true. However, the potential return comes with higher potential risk, which is often the equation with any investment. Higher risk equals higher return. So you're not seeing anything unusual here. It's a great point. Private equity is less liquid, lacks the transparency of public markets, and often comes with higher fees. It may also add due diligence burdens for investors who may not have the time, expertise, or interest in putting in the work. That's a really key point, because when people are choosing their investments for their 401k, generally speaking, what folks tend to do, because again, most people are not investment geeks, right? You look for whatever has had the highest return in the past year, the past 5 years. That doesn't necessarily mean it's going to have the highest return going forward. And also, unfortunately, most investors don't look at the fees associated with some of these funds they own. So that's kind of a warning signal there that she is pointing out. Then she goes on to say, she's talking about the order would instruct the Labor Department and the SEC to guide employers on including private assets in 401k plans. And she said the rulemaking process can take 2 to 3 years, perhaps longer than that, because the SEC headcount is down 15%. So there's a problem there with the SEC headcount being down. I definitely understand that. This could be a while, in other words, before it happens. But I'm going to show you something in a minute, is that many of these fund companies, the ones that already supply the funds for your 401k, they're working on these. They're putting these together. And some of these are going to be introduced as early as next year. So let me see here. So Courtney said a few other things. She went on to comment a little more. Could pave the way for, an order could help pave the way for managers of these big private equity firms to access the vast sums of retirement savings held by workers who don't have a traditional pension. And right, hardly anybody has a traditional pension anymore. I know for government workers, that's more common. In some union jobs, it's more common. But most private sector workers do not have a traditional pension anymore. You're relying on that 401k. And what Courtney says here, let's be clear. I love this. This isn't an altruistic mission. Managers of private assets want to increase their fee base. Absolutely. This is a new opportunity for them. And of course, every asset manager, every business has to make a profit. I understand that. But again, in this case, investors need to have a buyer beware kind of attitude here. Now, she goes on to say, because of the greater due diligence required for plan administration, fees could go up for everyone. You know, the structure of the private market industry is there's a lot of research that goes into these, a lot of transactions in that industry. The costs are just much higher, much higher than if you just have a regular S&P index fund in your retirement account, or any other index fund, really. If you have an index fund of foreign stocks or small cap stocks, doesn't matter. This is going to be significantly more expensive. It just is. And then let's see, the last thing here, investment and retirement industry executives expect it will take further developments such as congressional action. Okay, and then this, I love this. This is a waste of time. Congress doesn't need more distractions. No kidding. Okay, so I liked that because Courtney's comments here got me thinking about something I had written about a little bit before, but she really highlighted the danger of these. So let's talk about the transparency for a minute. Okay, this right here is the fact sheet for an ETF ticker COMB, C-O-M-B. It is a commodities ETF. And at one point a few years back, I did have clients in this in small positions just as a diversifier, okay? Commodities are another form of investment that many investors aren't really familiar with, don't understand them that much. However, the difference between a commodities ETF like this and some of these private market investments that I'm talking about today, you can see right here every day what you own. ETFs, they publish their holdings every day. I mean, you can see right on there, download holdings as of July 17th. So I'm recording this on Sunday, July 20th. So that's, I think, the most recent one they had there. Even mutual funds that are maybe they don't publish their holdings as often, they're not required to, even those are published monthly or quarterly. So you always have an ongoing sense of what you own. So in here, you can see the different categories of the commodities you own, the sector breakdown, and the way a fund like Comb works is they own futures contracts for these commodities. And then they also hold some treasuries. They usually hold some other cash equivalents in small portions. But you can see what you own here. That's the big difference. If you have one of these private equity funds, it's not necessarily the case that you're going to understand or be able to see what it is you own. So let's look a little bit at what some of these companies are doing here. BlackRock, biggest asset manager. They are looking into getting into this business, and they have some plans in place already. You can see right there, accelerating a push into private investments by including them in funds for 401k retirement plans. And they plan to offer a target date fund with a 5% to 20% allocation for private investments. So this is coming. And the thing about a target date fund that's even more worrisome is that's just a package of stuff, right? You're just buying kind of something that's prepackaged based on the year that you plan to retire. So if you think people are not looking at the contents of their 401k, that's even more true with a target date fund. So this is a little bit more from another Wall Street Journal article here. Show you there. It says the fees are higher. And Great Gray, which manages over $210 billion, plans to charge an average of 0.38% for its new target date fund. The fund is using stock and bond index and private equity investments. Now, proponents say it can boost returns. Sure, yeah, could earn an extra 0.5% annually before fees, compounded over 40 years, and that's a reasonable amount of time for a retirement portfolio. That could produce a 401k balance 15% higher than a similar target date fund without private investments. Okay, so the issue with that is that doesn't sound like a whole lot, that 0.5% annually, but the 15% compounded over 40 years, sure, that might get your attention. But that extra fee of, what did they say, 0.38%, plans to charge an average of 0.38%. Okay, just be careful of that. Again, the fees are something that most investors tend to not look at, but, the fees add up over time. Again, over what you might have in just a regular index fund, just something that's tracking an index in your 401k. This thing, not only for that extra return, you're adding extra risk and paying more fees. I really can't emphasize that enough here. Okay, and just to kind of underscore the point, what you're looking at on this chart here, and again, this is just kind of showing you the possibility for that extra return. I do want to acknowledge that here. This is kind of shorthand. So you see at the top, this chart here compares the stock price return for 3 private equity stocks, KKR, Apollo, and Blackstone. Not the same as BlackRock. BlackRock is below. So you see, over the past 5 years is what this chart is looking at, how you've got a whole lot more volatility, right? You can see the bigger price swings in these private equity firms, in their stocks. That's kind of a shorthand there, a proxy for some of the risk that these firms are undertaking. But you also see they did have better returns. And on the bottom, you've got some of the traditional asset managers, BlackRock. You've got Benjamin Franklin Templeton is what that is. Ben, it's a cute ticker symbol. And STT, which is State Street. And they manage a lot of those ETFs, like the SPY and many other ETFs. And BlackRock runs iShares. So a lot of these are just very, very common fund managers that you may find in your 401k, just managing index funds. So that's just a shorthand way of showing you the higher risk, higher return potential of some of these private equity managers. So what's going on here? What's behind this push to get more of these private market investments in your 401k? The managers aren't doing this, like Courtney said in her notes. They're not doing this to be altruistic, right? The reason that we're seeing this, one reason anyway, is that it's becoming more difficult for investment managers to eke out some excess return through stocks. So one thing, and you might be familiar with this if you're a regular investor, follower of the stock market, what we're seeing lately in the past couple of years has been a really outsized effect on the S&P 500 from some of these top-weighted companies. And they're the usual names, the Magnificent Seven, of course. People used that term a couple years ago. You've got NVIDIA, Microsoft, Apple, Amazon, Meta Platforms, Facebook, Broadcom, the two share classes of Alphabet, Tesla, and then Berkshire Hathaway. So, you've got all these big companies that are really causing outsized effect on the performance of the S&P 500. That limits what investment managers, professional institutional investors can do in terms of generating a higher return for their clients. So let me show you this too. The reason, another thing, in addition to kind of coupled with this outsized weighting you're seeing of a very few handful of companies that are just dominating the U.S. markets, is the number of U.S. listed publicly traded companies has actually declined over the last several years. Let me just see over here. I've got some notes over here. Yeah, so right now, I think the number of publicly traded companies is something like 4,300, and that's significantly down. You can see back here in the mid-1990s, it was over 8,000. So, a lot's happened. It's become more difficult because of bureaucracy for companies to get listed. There's been a lot of mergers and acquisitions. A lot of companies go public, small caps, and then they have the idea, well, even though we're public, we are going to get acquired. That's how our investors are going to get their return. So there's a lot of reasons for this, but nonetheless, the effect is it's harder for managers to get excess return from the stock market now. So what are they logically going to do? Turn to other types of investments. So that's why you're going to start seeing some of these private market investments in your retirement accounts. And even, just want to show you this too, Vanguard, right? Some of you may have retirement accounts with Vanguard, funds with Vanguard. I mean, they are a really good company. And they were among the pioneers of index funds. The founder, Jack Bogle, he's done a lot for investors. Vanguard is known for keeping fees low, for really simplifying investments. And I've had clients in a lot of Vanguard funds in the past. I've owned them myself. But Vanguard is now getting into the act too, so they're not immune from this. And you see right there, the part I circled, Wall Street is feverishly embracing private markets, and Vanguard, like other giant money managers, wants a foothold. It's working with Blackstone and Wellington Management, and Wellington has actually partnered with Vanguard for years to develop funds. But now they are going to be offering products that have a mix of public and private assets. So you've got State Street, Apollo, Blackstone. I mentioned those before. These are some of the companies that are joining up with some of the traditional asset managers to launch 401k target date funds, and what it says here with approximately 10% exposure to the private markets. Okay, just be aware. When you see this in your 401k accounts, just know that this is happening here. You know, a lot of people, like I said, you might base your 401k choices on what's done well in the past. That's no guarantee they're going to continue doing well in the future. Asset classes rotate in and out of leadership. I'll show you in another video. There's plenty of these kind of crazy quilt charts that show you how that works, and they're kind of fun to look at, but it shows you that something that was the top investment this year could be at the bottom next year. Happens all the time, and then vice versa. So you never know. And it just, again, you don't want to pick an investment just because it's done well in the past. You might get attracted by the higher return of some of these private market investments, but don't get too carried away by that, because there are the higher fees and there's no guarantee that that outsized return will be consistent. Know what you're buying. A lot of people I know, when they invest, they want to kind of feel smart and sophisticated. You know what? Wouldn't you rather retire smart than rather kind of feel smart right now? All right. Thank you so much for watching. This was kind of my first my first time trying the eCam Live software. I hope it went okay. And I put the thumbnail, I meant to say this earlier, I put that danger zone, and I keep getting that Kenny Loggins Top Gun song from the 1980s. It's kind of an earworm in my head. And if you've watched this far, maybe I've just given you an earworm too. All right. Once this is processed, I'll put a link in the description for my ETF lead magnet. And thanks for watching today. I appreciate you. Catch you next time.